A tax-advantaged benefits account lets you save pre-tax money from your paycheck for IRS-qualified out-of-pocket health expenses such as childcare, doctor visit copays, hospital stays, prescription drugs, commuter parking and transit costs, and more. Nextep offers a variety of options. Let's begin with the Flexible Spending Account, or FSA. You can use your FSA to pay for qualified out-of-pocket health, dental, vision, or prescription expenses with a special debit card at the point of sale or via reimbursement. Each year, you can contribute up to an amount determined by the IRS. Plan carefully, though. Your annual FSA contribution is mostly use it or lose it. You may roll over a certain amount of unused money each year. After that, any leftover FSA funds are forfeited at the end of the grace period. We recommend visiting the FSA store online to use any remaining funds. Another option is the Health Savings Account, or HSA. It works similarly to the FSA, but with a few key differences. Unlike the FSA, all unused HSA funds can be rolled over from year to year. In fact, you can take an HSA with you after you leave your company and use those funds well into retirement. Also, you may only contribute to an HSA with a high-deductible health plan, or HDHP. This differs from the FSA, which can be paired with any plan except the HDHP, or even with no health plan at all. One purpose of the HSA is to help offset the additional costs of having health insurance with a higher deductible. You can stack most of the other tax-advantaged benefit accounts on top of one another. However, you cannot contribute to an FSA and HSA in the same plan year. A limited-purpose FSA, or LPFSA, allows you to deduct a set amount of pre-tax money from each paycheck to pay for qualified dental and vision expenses, such as dental and vision checkups, copays, braces, glasses for you and your dependents, and travel to appointments. To participate in an LPFSA, you must be enrolled in a high-deductible health plan, HDHP. You may use an LPFSA and HSA concurrently, but you may not use both an LPFSA and FSA in the same plan year. A flexible spending account for dependent care, or DCA, allows you to set aside funds from your paycheck pre-tax to pay for qualified dependent care expenses, including your children ages 12 and under, a disabled spouse, elderly parent, or other dependent in your household who is mentally or physically incapable of self-care. Dependent care expenses must be work-related, necessary for you, your spouse to work, look for work, or attend school full-time. Like the FSA, annual DCA contributions are also use it or lose it. Unlike the FSA, you may not roll over a small set amount of unused funds from one year to the next. Finally, we'll talk about the Parking and Transit FSAs. These accounts each allow you to set aside pre-tax money for work-related parking or mass transit commuting expenses. It's important to note that the Parking and Transit FSAs are for work-related transportation expenses only. You can reimburse parking fees and transportation expenses for medical care with your FSA or HSA health-related accounts. You may hold parking and transit FSAs concurrently with any of the other tax-advantaged benefits accounts. Unlike traditional FSAs, the IRS does not have a use it or lose it rule for parking or transit FSAs. Any unused funds at the calendar year's end roll over to the following year. To learn more about the ins and outs of your tax-advantaged benefit account options, including descriptions, eligible expenses, how much you should save, and how they save you money, check out our FSA 101 guide online.